Earnings season so far has painted a mixed picture on the consumer, but new data out from Bank of America showing that spending is actually off to a stronger start this year. Credit and debit card spending was up in January, growth of about 5% from the numbers that we saw a year ago. So for more on that, we want to bring in Ann Berry, founder of Threadneedle Ventures. And I think a lot of people, when they're trying to figure out whether or not the rally that we've seen since the start of the year, if that's going to continue, hinges on the consumer, the strength of the consumer at this point. What do you think?
If it does, I'm really nervous because I think this consumer buoyancy, the way in which the data is being read is really positive. It's the positive spin. Credit card spending's up. You know what it also means? The consumer's taking out more debt. And what I worry about is savings draw down for the rest of this year and that debt load is going up. I don't think it ends very well for the consumer towards the end of this 2020.
Is there data showing that concern in terms of debt? Because, I mean, yes, to your point, the credit debit spend is how they're lopping it together, 5.1% increase versus 2.2% the prior month. Isn't the consumer just in better shape than we thought?
Well, first of all, that number excludes BNPL, right, which is a whole category that no one talks about, which is another form of consumer debt. Small relative to the credit card debt.
Very small and shrinking.
But it popped over the holiday season. When you looked at holiday spending, it became, a little bit more significant. Other kinds of data. Record numbers of consumers are tapping their 401k right now to pay for medical emergencies and to pay for mortgages. So not every consumer is the same, and I think the hardest hit, as always, are the ones with very limited savings.
What about earnings season so far, just given the state of the consumer? I mean, look at consumer staples. We're hearing a bit of a mixed picture just in terms of sometimes consumers are willing to pay those higher prices that companies have raised over the last couple of quarters versus other names, some in the luxury space, that are starting to see a bit of a backlash. People simply aren't spending. What's been your takeaway from earnings season so far?
Well, on the consumer side, it's interesting. Luxury really held up as you looked at it over the last couple of years. Two areas tend to do well when the consumer's under pressure. Luxury, because the very wealthy tend to be insulated from some of these macro forces. And then value, the Walmarts, the Costcos tend to do very well in these periods. I think we've seen that. I think luxury paring back makes sense, but I think we're going to see value continue to do quite well.
When you look at a company like Pepsi, we've seen them increase prices beyond the rate of inflation. And what they're seeing is demand has dropped a little bit and volume has dropped a little bit, but those price hikes have more than made up for it. So they have no reason to lower prices. What does that mean for the Fed?
Yeah, I don't think prices are going backwards, by the way. And Chipotle, I think it's Chipotle who came out and said, we hiked up prices. They're not going to go up anymore, but they're not coming down either.
Right.
So, and that's important. Inflation is the rate of increase. So I think as long as we see the increases stop, things can start to stay still. That makes the Fed's life easier. But I don't think we've stopped seeing companies put up their prices yet behind the excuse of ongoing inflation. That cycle's got to break. It's not broken yet.
So what does that mean then for equities? Because if you at least look since the start of the year, we're off to a strong start with the S&P and the NASDAQ. Can we continue that momentum if we don't see substantial improvement in inflation?
I don't think so, because we know the Fed's been super clear, and I'm actually a little bit confused by what's happened in the market. Jay Powell was super clear. Rates are going to continue to go up because inflation has not yet come to the point where it needs to come. I just think the sentiment is baked in right now. I think investors are excited to finally see companies come up with plans. Dan Ives just said, here's what was disappointing about Lyft. Crickets, there's no strategy. We don't know what execution is going to be. This earnings season, we have seen companies come out with real plans, with concrete paths towards profitability. I think that's why you see a relatively strong market, but I don't understand it in a macro sense.
In some cases, those plans are being forced by activist investors. There's been a real increased trend. So we started with Blackwell's Capital on Peloton. We had Nelson Peltz, who says that is over in regard to Disney. Elliott Management and Third Point with Salesforce. Ryan Cohen with Nordstrom. This is just to mention a few. Is there a common thread here amongst all these activist investor moves we're seeing?
Well, you've mentioned the ones that have actually affected change. Some of the activists come in, they have change, they don't have change. What's so interesting to me about Disney and now Salesforce, these are businesses with huge amounts of stickiness, with really strong brands, which have historically had, pretty good response to their management teams. And yet these activists are coming in and saying, no, we're finding things for you to do. And so what I find interesting about this is they're succeeding in getting change. And it's also raising a broader question of why aren't these teams figuring this out themselves before the activists come in?
You see the skepticism on my face, and that's because Nelson Peltz.
Tell me about why are you skeptical about Nelson Peltz?
What did he do there? He didn't affect any change. Bob Iger was going to do this with or without Nelson Peltz.
How do we know that?
He took a victory that he had nothing to do with.
I don't
He
remember.
wanted a board seat, and they ignored him. They said, sit over there in the corner.
I feel the heat. This is great. When did Bob Iger specifically come out and say...
He's been on the job 2 months.
But he didn't come out and say, I'm going to take $3 billion of cost out until Nelson Peltz came out and said, here's what the activists do. And this is what happened with Peloton. Here's a really specific plan with specific actions I want this management team to come up with. Bob Iger came back. I rang the victory lap. I'm a retail, full disclosure shareholder in Disney. When he came back, I was thrilled, right? But he didn't have a plan. He didn't have anything specific until he was, to your point, a little bit of time in the seat. You don't think
those things were already in motion? You don't think that was Bob Iger's plan? And by the way, the dividend, we don't know how much it is. It was a modest dividend at a later date.
If what Nelson Peltz did was force communication with the market, so we went from perhaps something is on the come to here's now something specific that we can hang our hat on when it comes to actual earnings forecasts and the outlook. From a shareholder perspective, I like that.
Sorry to hijack the comment.
Yeah, I was going to say, how do you look at it, though, from an investor's perspective, right? If there is activist investor involvement, is that an opportunity then, do you think, to get in and buy some of these stocks?
So it really depends. And to go back to the Disney example, because it's so much fun that we get so riled up about it. Okay, here's why I like that situation. Again, it was about specifics. This was the same with Peloton. Here's a very specific plan. It was very analytical, it was very rigorous, and it was very operationally focused. That I like, because then you've got a CEO who's able to respond to something specific. What I don't like as a shareholder is if an activist turns up, makes a bunch of noise, doesn't have something specific to respond to, then that's a distraction for the management team, and that is actually not good for the shareholder. So there are different kinds of approaches to
So like Ryan Cohen and Alibaba, that one doesn't make any sense to me. You're dealing with the Chinese government. How are you going to enact change?
Well, in that case, and I'm not in Alibaba, that's where I would say that falls in the bucket of saber rattling, and then it's just going to be one more thing for a CEO to deal with other than creating value.
I guess I'm just saying, I think like Barry McCarthy deserves more credit too in the case of Peloton. He came in, he's been trying everything since starting there, only been on the job about a year.
Yep.
I'll stop my rant, but it was a good discussion. Good back and forth.
It's a great discussion.
But as a great CFO, he's a CFO. He's a capital allocator. That was his superpower.
Well, they certainly are. We're seeing a change at a number of these companies. And Barry, always great to have you. Thanks so much for coming on the studio for us.